Today we are diving into two Vanguard index funds that absolutely crushed S&P 500 in 2024 and might just do it again in 2025. Both funds are budget friendly with expense ratio just below 0.1%. With AI spending expected to grow by 36% annually through 2030, these funds are in a strong position to continue delivering excellent returns. So if you are ready to unlock your portfolio's potential and want to beat the S&P 500 in 2025, then this video is for you to watch. So let's get started. Thank you again for joining me today. I am Pankaj. As always, everything shared in this video is for informational purposes only. First, a quick history about Vanguard. Vanguard, which was founded by John Bogle in 1976, revolutionized investing with the industry's first index fund for individual investors. Today, Vanguard is a global leader offering some of the lowest cost investment options on the market. Their focus on passive investing has helped millions of investors grow their wealth over time. Let's talk about the two Vanguard growth ETFs that delivered outstanding return last year. First, Vanguard S&P 500 growth ETF with ticker symbol VOOG. Second ETF is Vanguard Russell 1000 growth ETF with ticker symbol VONG. In 2024, VOOG returned a whopping 36% and VONG delivered an excellent return of 33%. When we compare that to the S&P 500's 25% gain in 2024, then you see why these funds are worth a closer look. Starting with VOOG, it tracks the S&P 500 growth index, which includes companies with strong revenue, earnings, and momentum. Its portfolio of 237 stocks is heavily weighted towards three key sectors: technology, which is 50%, consumer discretionary, which is 15%, and communication services, which is 12%. The top holdings include tech giants like Apple, Nvidia, Microsoft, Amazon, Meta, and Alphabet. Over the last decade, VOOG delivered a massive 400% return or 15.1% annually. So the CAGR is 15.1% compound annual growth rate, which is really excellent. That's well above the broader S&P 500 330% gain. Let's take an example. If you had invested $10,000 in VOOG 10 years ago, today it would be more than $40,000. So in 10 years, the initial investment has grown over 4 times. This ETF is low cost with expense ratio just 0.1%. And assets under management is almost $15 billion. From Seeking Alpha, this ETF grade ranking is excellent. With momentum, expense ratio, risk, and liquidity, all of these are above A grade. Dividend grade is low, and there is a reason for that, since this is a growth ETF. However, the dividend is not that bad. It is 0.49%, which if reinvested year over year, gives an excellent total return. Now let's look at VONG, which tracks the Russell 1000 growth index. With 397 stocks, it has slightly lower exposure to technology at 49% and consumer discretionary at 15%. Its top holdings are very similar to VOOG, but with slightly different weightage. Major holdings are in Apple, Nvidia, Microsoft, Amazon, Meta, and Alphabet. Over the past decade, VONG outperformed VOOG, delivering a 460% return, which is 16.6% annually. So the CAGR is 16.6%. That is again excellent. This ETF is again low cost with expense ratio only 0.08%, which is lower than VOOG's 0.1% expense ratio. VONG is managing almost $33 billion of assets. From Seeking Alpha, the ETF grade ranking is again excellent, better than VOOG. With momentum, expense ratio, risk, and liquidity, all of these are above A grade. Dividend grade is B+, and there is a reason for that. Since this is a growth ETF, however, the dividend is not that bad, and it is 0.56%, which if reinvested year over year, gives an excellent total return. Let's check the overlap between these two funds. When we compare the overlap between VOOG and VONG in terms of weight and number of holdings, we find that about 86% of their weight is shared. Further, 158 holdings are common between the two funds. This means if you invest in both ETFs, 86% of your investment will go into the same companies. Looking deeper, nearly 50% of your investment will be concentrated in just 5 companies: Apple, Nvidia, Microsoft, Meta, and Alphabet. This is a crucial factor to consider when investing in multiple ETFs. So why this ETF could be a win in 2025? Both ETFs are positioned to benefit from explosive growth in AI spending, which is projected to grow at an annual rate of 36% through 2030. With tech giants leading the charge in AI innovation, these funds are poised to outperform the broader market once again. So which ETF should you choose in 2025? Both VOOG and VONG are excellent options. But if you want slightly higher tech exposure and lower fees, VONG could be the better pick. On the other hand, VOOG's balanced sector allocation makes it a bit less volatile. It all depends on your risk tolerance and investment goals. So which Vanguard ETF you will add to your portfolio in 2025? Let me know in the comment section. And don't forget to like and subscribe. That's all for today's video.